A very good afternoon to our guests and its distinguished panel of speakers joining today. Welcome to our ESG Uncovered series. Today's session is titled Rising Tide, Adapting to the Changing ESG Regulatory Landscape. This is the second of a two-part series hosted by EcoBusiness in partnership with S&P Global. I'm Junice Yeo, Executive Director at EcoBusiness. We are Asia Pacific's leading media and intelligence organization dedicated to sustainable development and responsible business. For many of us in Asia working in the trenches of sustainability since a decade ago, the pace at which the environment and social narrative is mainstreaming today is electrifying. From the humble spreadsheets showing basic environmental data to what is now a plethora of solutions capturing critical climate risk information made into forecasts and scenario planning, there is every reason to be excited about the momentum all around us. For the team at EcoBusiness, our role is also quickly evolving. From our early beginnings as an independent journalist platform, today we are proud to be the leading voice on sustainable development and ESG intelligence, bringing together even more global policymakers, business leaders, academics, and civic society, all of whom are eager to shape what is becoming the most important challenge facing our global generation, as well as the generations ahead. As such, we are proud to be hosting this dialogue series today with S&P Global as part of our ongoing efforts to cover important sustainability topics across the region. You may have uncovered, you may have come across our feature series titled ESG Uncovered on our platform. Alongside S&P Global, we are building this thought leadership series to deep dive into the state of sustainable investing and responsible business in Asia. And with this webinar series, we hope that we provided a clear pathway for businesses in navigating what is commonly known as the alphabet soup of disclosure framework and standards, giving practical takeaways on how to adapt to this shifting regulatory environment. To briefly recap on what we covered in part one of this webinar series, we discussed three key issues. Firstly, how disclosure frameworks are being applied in key markets in Asia. Secondly, what the future holds for ESG regulations, bearing in mind that key stakeholders, the central banks, exchange commissions, and even investors are likely to get tougher on intentional and inadvertent greenwashing practices. And thirdly, the outlook for Asian businesses on how they should prepare for the impending scrutiny into their ESG credentials. So in part two today, we continue this discussion. What was previously a fringe topic, ESG has now gone mainstream. As pressure from stakeholder groups increase, E, S, and G issues are now among the top agenda for investors, boards, and the C-suite. Regulatory developments in Asia have been key in bolstering the ongoing ESG momentum. The stock exchanges in the 6 largest ASEAN member states, who are Indonesia, Malaysia, the Philippines, Singapore, Thailand, and Vietnam, have now implemented ESG disclosure requirements for listed companies. For Singapore in particular, SGX has announced last year that it will implement a phased approach in requiring listed companies to provide climate-related information based on the guidelines by the Task Force on Climate-Related Financial Disclosures, or TCFD for short. However, while Asia's major financial hubs have managed to achieve a reasonably high level of ESG disclosure standards in a few short years, the reality is that the frameworks, standards, and reporting requirements are still constantly evolving in our region. Now, this poses a challenge for many businesses, especially for those who are still wrapping their heads around how they should even begin to comply with these standards. These questions then arise. What are the challenges and opportunities that businesses face in meeting increasingly rigorous sustainability reporting standards? What are the examples of the best and worst disclosure practices? Is your business ready for growing regulations? I myself am eager to have my finger on the pulse. And so, together with my colleague, Megan C., and we are pleased to bring together some of the region's key opinion leaders to discuss these critical questions. And we hope that this timely conversation will help guide Asia's businesses as they prepare for the changing regulatory landscape. Once again, thank you very much for joining us today. I hope that this session serves its purpose in shaping a better understanding of the path ahead. Megan, over to you.
Thank you, Janice, for succinctly capturing the essence of and setting the scene of today's dialogue. I am Megan C., Director of Partnerships for Eco-Business, and I'm pleased to be your moderator for this session. I'd like to encourage all of our audience today to be involved by sharing your thoughts in our chat boxes and also send your questions to our panelists, as we will be having a Q&A session a little bit later on. But with that, I'd like to introduce to you our panel of very esteemed speakers. With us today, we have Karina De Vricha, Global Lead, Market Strategy and Development, Climate Linked Credit and Risk Solutions, S&P Global Market Intelligence. We have also Sherry Tan, Head of Public Affairs, Science and Sustainability for Asia Pacific Bayer Crop Science, Michael Tang, Head of Listing Policy and Product Emission, Singapore Exchange Regulation. Last but not least, Marla Garun Alvarez, Vice President and Sustainability Officer, Sustainability Office for BDO Unibank Inc. Welcome all, and thank you for joining the panel today. We have a lot to go on, so I'm just going to go right into the meat of the topic. But first, posing this question to Michael. The regulatory net is tightening, as we all know, particularly for financial institutions, insurers, asset managers. But what are some of the highlights of ESG regulatory changes in Singapore and elsewhere in the region that we need to be aware of? Michael?
Thanks, Megan. Thanks for having me here today. Maybe I'd like to start by taking a step back and just looking at the key events that happened in the last 5 years. I think one of the key events that led to, I guess, this proliferation of regulatory change is really the issue of the recommendations by the TCFD on climate disclosures. And that, I think, really galvanized the financial sector, as well as the central banks and the securities regulators around the world around this issue as to what is useful information that investors, that asset managers, the insurers, the banks would need in order to make informed investment decisions. And I think looking at the net today, I would bucket regulatory change and rules into 3 different areas. The first one is really on taxonomy, which is essentially a classification system for what counts as green, which economic activities actually contribute towards our pathway towards a net zero. And in this regard, in Singapore, just last week, I think we've seen the Green Finance Industry Task Force, which is an industry-led body in Singapore, convened by the MAS, the central bank and regulator in Singapore, issue a public consultation for a taxonomy in Singapore focused on 3 specific sectors on energy, transport, and real estate. And they've proposed a traffic light approach to looking at economic activities, with green representing those that are fully aligned with climate mitigation and net zero, amber for transition activities, and red for those that are not compatible with this pathway at all. The second bucket of regulation I would raise is really around prudential regulation on asset managers, banks, insurance, essentially financial institutions. And this is really in response to concerns from regulators about whether or not our financial institutions are resilient to environmental risks, given the risks raised by the TCFD on physical and transition climate risks. This bucket really represents the specific actions within financial institutions that are necessary to ensure that they manage their environmental risks soundly, and they adopt leading practices to manage these risks. The third bucket of regulation really focuses on the disclosures by companies and corporates. And in this regard, as I think Jonas has mentioned earlier, SGX recently rolled out new requirements for all companies to report on their climate action and impacts based on the TCFD recommendations. This really builds on our existing rules on ESG and sustainability reporting, which we have already introduced in 2016. So these, I think, 3 buckets are really the key regulatory changes that we've seen taking place over the last 5 years, not just in Singapore, but I think across the world. Maybe to cite a recent example, I think in the last half a year, we've seen Malaysia as well as the US SEC issue consultations on climate reporting by corporates. And I think that is very aligned with this movement towards adopting TCFD recommendations that I think a lot of regulators are looking at.
Thank you for that, Michael. And actually, on that point on your disclosures and on banks as well, having that focus there, I'm going to move on to Marla because we know that international frameworks such as the GRI, TCFD are shaping ESG region. And in particular, recommendations from the TCFD should be integrated into the Philippines sustainability reporting guidelines for publicly listed companies, where it's emphasized that ideally all firms should disclose climate-related risk. So in your kind of a line of work as well in a bank, what might be some of the implications for those who do not prepare for and adhere to the rigorous disclosure and transparency requirements?
Thanks, Megan. I think the key words really would be investors and risk mitigation. I always tell our senior officers that we have to remember that the TCFD was really created for investors, and it's to help investors make informed decisions on where to invest, on credit, and how and where to underwrite insurance based on climate related issues and how businesses or companies are dealing with this. At the moment for banks, I can say that there is really so much investor pressure for us these days to support and report following TCFD recommendations. And behind that really is the investor preference that they are more inclined to invest or add to their investments in companies that do make disclosures around their climate related risks, as well as their approach in mitigating those risks. They also want to see what the opportunities are for the banks around climate mitigation. And the implication is that the reverse of that is they're really prepared to move their investments elsewhere if that is something that banks will not do eventually. So specifically for financial institutions, it's the physical risks and transition risks. For BDO, physical risks would be for our over 1,400 branches nationwide in the Philippines. That's the largest network of branches for our country, and we have to make sure that in a very disaster-prone country such as ours, geographically, we are able to make the right decisions on where we put our branches, how we situate that in the community so that they can continue to have access and we can continue to work or implement our financial inclusion programs among the unbanked and underserved communities around the country. Transition risks, of course, would be on our loan portfolio around fossil fuel investments. But if we are able to mitigate both physical and transition risks, then not just BDO but other companies can be stronger and in effect better able to withstand any major disruptions related to climate change. The pandemic, for example, while a bit more related to biodiversity, was one of those major disruptions. And looking at how we responded using governance and our ENS risk assessment, we were very effective in immediately addressing our customers' needs and providing an excellent response to our employees as well. So that will really make more companies, more banks better, more resilient in handling disruptions. And then on the insurance side, for our insurance business, BDO Life, there's the liability risk. There's a growing number of climate related litigation around businesses that may suffer climate related events. And if there was not sufficient information provided around their exposure to these climate related financial risks, then um, there might be claims or there is an opportunity or there is a possibility for liability risk against these businesses. And finally, we do anticipate that there will be more regulations coming, and what is happening in Europe will eventually trickle down to Asia Pacific. So we know that we need to be prepared for that. Otherwise, we have this saying in the Philippines where we say maiiwan ka sa pansitan, or you'll be left behind at the noodle house. While everyone else has eaten and left, you'll be left behind trying to catch up, and you'll have to pay a heftier bill in the process because you're trying to catch up, and there are deadlines to this. There are solid commitments that need to be articulated, and you have no choice but to throw money at the problem so that you can catch up.
Thank you, Marla, for that. I really like that Philippines phrase. You need to type it out in the chat as well so that we can use that. But you did speak a little bit about how investors want to see companies disclosing risk and also how they are mitigating these risks as well. So I'm moving on to Perna. In your line, we know that evaluating climate risk scenarios is a process that companies go through to analyze how their businesses would be impacted in different climate scenarios. So in this line, how is it practical? How practical is it to use climate risk scenarios in decision making, such as your credit risk and climate reporting process, and how really should companies start on this process?
Yeah, thanks, Megan. I would say I think we need to really appreciate that there is tremendous utility in climate risk scenarios, because if you think about traditional stress testing, which we've all come to know in terms of capital-related exercises through the work of central banks around the world. Those scenarios and stresses tend to be anchored in macroeconomic factors. They tend to have 1 or 2 year horizon, and they're typically focused on capital levels and resilience in the banking system. Climate, on the other hand, is a much longer term risk, and the industry is being asked to look out over a longer term horizon that one has not really heard of or experienced. There is no historical data to backtest and validate against all of this. So the value of climate scenarios, as produced by various bodies, think of the NGFS or the IPCC, and the climate science community as a whole, is incredibly important because it will advise institutions on how to take into account all of the factors associated with climate scenarios and then translate them into economic impact at the customer level, at the portfolio level. And this is also, highlighted in the pillars of TCFD, including the strategy and the risk management pillar, as it relates to disclosure of, the actual and potential impact of climate-related risks. Not only that, I do, echo comments from the others that, this will continue to evolve. As we look at the progression of climate scenarios today, we're now seeing the addition of more variables, more downscaled impact, and values associated at country level by the NGFS, and we continue to expect that there will be advances both on data as well as methodologies over time. So keeping it simple and agile by referring to such external open sources for scenario analysis. If one wants to build a model in-house or explore tools where academic homework is already done for you, and incorporate that into your internal sort of climate risk practices and policies, and that would be sort of my recommendation.
Thank you, Prerna, for that. And you also did touch upon, this disclosure of climate-related targets as well. And from the business perspective, I'm sure a lot of our audience here want to know, Sherry, what is holding businesses back in terms of improving in its disclosure of climate-related targets? And, in line with that as well, Mike, I'm sure you can chime in as well. If we need more regulatory arm twisting, and if so, what kind of a regulatory arm twisting would be most effective, for businesses to get there?
Yeah, thank you, Megan, and hello to my fellow panelists. So for those of you that are not familiar with my company, Bayer is a global leader in healthcare and nutrition. We are here to ensure the world has a reliable supply of high-quality food, feed, and plant-based raw materials in line with our vision of health for all, hunger for none. So I'm part of the crop science division in APAC with businesses in crop protection, seeds and trade, and digital farming. So to put your question in some context, Bayer is a signatory to the SBTI, business ambition for 1.5 degree Celsius, and we've committed to reaching net zero emissions for our entire value chain by 2050. So these commitments include a reduction in scope 1 and 2 emissions by 42%, a reduction in scope 3 emissions by 12.3%, and then also a marginal offsets of remaining emissions in scope 1 and 2. So we've been diligently reporting on our progress annually, including in 2021, where we offset about 300,000 metric tons by financing reforestation and forest conservation projects all over the world, including in Indonesia. So what does this mean in Asia, and why are Asian companies, holding back from climate-related targets and disclosure? I think it's largely, firstly, it's hugely complex for companies to undertake understanding their environmental impact. Life cycle assessments can be such a big undertaking for companies, including understanding carbon footprint, identifying opportunities for reduction options. And then naturally significant investments are also required in decarbonization, and then simplifying complex supply chains, making shifts from fossil fuel dependence to renewable sources of energy. But, specific in Asia, I think what we do see is, for example, for ourselves as a large MNC company, a lot of our reporting is managed centrally at headquarters. And there's perhaps not as much examples of large companies that are working on climate-related targets and disclosure in Asia. But, as Michael says, this is slowly changing. The culture of Asian companies is such that, largely many are conservative and may be very prudent in their reporting. So ensuring that commitments are first understood at the top level of management and the board before they are publicly announced. So I don't think it's as much an issue of regulatory arm twisting. I think it's more about sensitizing the work, bringing more education and awareness to companies, and sharing more lessons to encourage companies in Asia to consider their disclosures. And then having said all of that, we are starting to see some shifts in countries. So for example, in India, there is more of a push for companies to disclose their ESG at a country level, and that the reporting needs to be very country specific. So I think in time we will see more of that come as countries start to also think about their reporting, and then requiring that down the entire industry, including from the private sector.
Thank you, Sherry, for sharing that. I would like to also hear from Mala and Michael on this perspective, because I know Sherry said that, it's not so much more of the more regulatory arm twisting, but really it's, for the company, for the board to be educated, to be kept aware of what needs to be done, and to synthesize all the information that they have to put it together. So Marla, I would like to hear from you first on this.
I absolutely agree with Sherry on that, on the regulatory arm twisting. In our case, in the Philippines, we know that even our regulators are on a learning curve with us. We're all learning about this together and trying to understand how the best practices abroad in Europe can be applicable to Asia and to the Philippines, because there are a lot of factors that make it more difficult for us and therefore may make it a bit slower for us to catch up. And then at the same time, what we actually need from our regulators are more guidance and more capacity building. I say that because, for example, at BDO, what we try to do is approach it from different points. And one is, on one front, we are incorporating the TCFD recommendations in our transition plan towards a sustainable finance framework. And this is mandated by our central bank for all banks. And they have given 3 years from 2021 to 2023 for banks to do that. And what we see in implementing our transition plan is that we're actually embedding what the BSP is asking for and what the TCFD is asking for. Because the mandate is to embed ESG principles in governance, in strategy, risk management, and metrics and targets, which is also what the TCFD is recommending. So we have been consciously integrating climate change in how we are looking at our operations, in our policies, in our programs, and not just climate change, but also I anticipate biodiversity as well. Just the other day, we signed with the International Finance Corporation for the first blue bond in Southeast Asia. Um, and that means we will be incorporating biodiversity in our disclosures as well in the coming years. And the other approach that we also did recently is to already incorporate the recommendations in our materiality assessment, which we did with S&P Global, PERNA, happily. And we are able to bring up ESG topics closer to the attention of our stakeholders this way, so that we can also determine their views and how they feel climate mitigation and climate risks would impact them, and how they see this as impacting the bank, vice versa. So we're not really starting from scratch in terms of our approach to TCFD. My disclaimer is that we haven't signed up for support, but well, we're not starting from scratch. We do tend to take our time to sign up because we always want to have meaningful and auditable metrics, targets, and disclosures, as opposed to simply following pressure and just winging it as we go along. So that's our approach.
Thank you, Marla, for that. And moving on to Michael, also for you to comment. I mean, I guess it must be quite a relief for you to hear that not much more regulatory arm twisting is needed.
Yeah, I think there are some things that regulation is good at, and setting, say, minimum standards and ensuring consistency of certain information and treatment. But there are some things that regulation is not so good at. For example, setting or requiring best practices, setting high watermarks, because it actually sets a standard that all companies must follow. And in an emerging, developing area like climate disclosure, I think this is something where there is probably more room for the market to lead. Regulation shouldn't go into the merits of specific disclosures and whether or not companies are indeed well equipped to meet these new requirements. So I'm quite glad to hear that regulation is not really to be seen as arm twisting, but really hopefully seen as a hand to guide you through together on this journey with us. But I think the other thing I would really like to add on is to really echo what Marla has said about the need for capacity building and guidance for companies. And that's something really that we are focused on in our latest requirements. We've also suggested a roadmap for companies to progressively implement the different requirements that the TCFD has. So companies would have, say, 2 years or 3 years to progressively improve on their disclosures. At the same time, we've also worked with the United Nations Global Compact Singapore chapter to organize training for listed companies in preparing a TCFD report that would meet our requirements and hopefully would also help to catalyze action within the company as to what they need to do in order to meet these new emerging norms.
Thank you, Michael, for echoing Marla and Sherry as well. I'm going to move on to you, Prerna. We just pretty much talked about how much the guidance and capacity building that's needed by companies in adhering to TCFD standards. So in the TCFD's revisions issued last October, there's a greater demand for banks, insurance companies, asset owners and managers as well to disclose their business activities such as their lending and investment strategies to ensure that they are aligned to their committed temperature-based targets. How should one prepare for it, and what sort of expertise, models, or data tools does one need?
Well, yeah, I mean, you're absolutely right. There are evolving demands from regulators, investors, and these have, of course, created new challenges in the way one analyzes, the way one needs to disclose climate-related risks, whether it's on a loan or an investment portfolio. On the data side, you mentioned data. One needs granular information on carbon emissions and on assets geolocation for firms that they're exposed to, right? So I'm thinking of this from the lens of a financial institution. Carbon emissions are often not reported in a standardized way or not even reported at all, especially for smaller companies. So does that mean we stop financing? No. The availability of a large standardized data set can help here and can become a leading indicator and critical to creating benchmarks or estimates that can be then scaled by company size and can help one then assist the likely emissions from these smaller companies. Similarly, with regards to geolocation of assets, one can perform a mapping exercise to identify major climate-related physical risk events, sometimes multiple, with different impacts. And herein as well, large databases of such information exist, like what we provide at S&P. And this can be used to influence decisions where, data is limited or data is unavailable. Similarly, on the modeling side, the transition to a low carbon economy is, influenced obviously by carbon tax levels. And there are differing levels, not only by country, but also by industry, and also in terms of the speed of implementation of, carbon tax and evolution over the next 30 years. So essentially, again, the whole sort of analysis is revolving around long-term horizons, and this is unconventional in nature. So this is perhaps just on the risk side. Then we need to factor in, obviously, the understanding of change in company behaviors, consumer patterns, and so there is also the opportunity aspect here for certain companies that can be ahead of the curve in their ability to adopt to greener technology. So then much depends on how companies will respond to transition. So here is where, again, going back to my previous point, climate scenarios can be helpful, and, the modeling aspect can take some cue from various temperature pathways, macroeconomic, as well as policy changes that can be used to develop an approach to quantifying financial risk. And then lastly, we have an important element in being able to model that impact, right? So you've got data on one hand, you've got scenarios on the other hand, and then you want to create that linkage of this data set, the scenarios, to impact, on the relative creditworthiness of a customer. And so for that particular linkage, here, a financial institution can choose to develop an internal model or explore services and off-the-shelf solutions from the market, such as what we have at S&P, a tool called Climate Credit Analytics that clearly links scenarios to financial impact through a very bottoms-up granular approach where one can see that linkage and financial impact.
Thank you, Prerna, for that. A lot to unpack there, but I just want to catch on to the point where we're talking about data and scenarios as well, and how companies kind of know, what's happening, but maybe not really. So I guess, all of us are kind of in the thick of the sustainable transition conversation, and we know that decarbonization has been such a huge topic in this space, although it might not be quite the case for others. Do you see, I guess we're coming to Michael first, maybe, do you see a trend of companies understanding or starting to understand how they might be impacted by the acceleration in decarbonization?
Yes, definitely. I think with the framework that the TCFD has provided in understanding climate risk, I think it's already, obviously prompted certain thinking within companies as to what the potential physical transition risks that they face and what is the potential impact on them. I think interestingly, the SEC in their most recent proposals on adopting TCFD recommendations have also asked that companies start quantifying in their financial statements the impact of physical risks or transition risks on their financial statements. For example, impacts relating to impairments due to loss of equipment due to physical risks, or increase lost revenues due to transition risk, impairment charges that they'll need to incur, or changes to the useful life of assets. They've also asked companies to disclose expenditures that companies are going to make in order to mitigate these risks, and what are the assumptions or estimates that would affect these risks. So increasingly, I think we'll see the market getting more familiar with quantification of these risks, and then incorporating these numbers into their financial statements. I think this will also be catalyzed by the recent formation of the International Sustainability Standards Boards and their new sustainable reporting standards, which is out for consultation right now. I think that will again make it clearer to companies what needs to be done.
Thank you, Michael, for that. And going on to you, Sherry, as well, to get your insights on this topic. We know that the companies know that they also need to start on the decarbonization journey. So what, our businesses like Bayer are doing to ensure that they're up to speed on that, and also to share some insights as well as to what obstacles, the company or other companies might be facing with this.
Yeah, so speaking specifically on Bayer and the commitments we are making, obviously, these commitments are also pegged to a significant investment. So we will be spending approximately 500 million euros through to 2030 to attain an absolute reduction in our emissions through energy efficiency measures. But having said that, I think that the policy developments in the agricultural sector is also shifting very rapidly. So while it's not just about our operations, it's also about supporting many of our customers. And in this case, these are farmers and largely smallholder farmers in APAC, to also understand what does this trend towards decarbonization also mean on the farm. And, farmers are talking about the EU Green Deal, which looks at the environmental impacts and disclosure from the farm level, and really supporting farmers in preparing them to understand how they can significantly reduce their emissions on farm, and what are some of the innovations that we can look at through R&D from the medium to long term to support farmers on more climate resilient, drought resilient seeds, to transition to more energy efficiencies within their farming, water savings, looking at lower carbon emissions as well, and digital tools that would enable farms to not only go digital, but use technology and applications that would, drive more efficiencies and carbon reduction.
Thank you, Sherry, for that. And I'm going on to Marla, sticking on to the topic of, the transition to net zero decarbonization. According to research, about half the world's, fossil fuel assets will be worthless, by 2036 under a net zero transition. What are some of the material risks associated with the greener economy, such as fossil fuel assets losing value and also becoming stranded?
Well, for banks, the risk really is losing the collateral value of our fossil fuel assets, since there are no resale options for us. And what is key is how fast we can shift to clean energy to mitigate financial losses. So, in our case, for BDO, for example, we have been into sustainable finance for the past 11 to 12 years, and it has always been risk categorized, and it has always used an E&S criteria in terms of categorizing the risk. So we are looking into our loan portfolio right now and assessing how we are going to support our clients for that transition and how we can transition faster. But we have stopped lending to new coal projects since 2019. Now, the other material risks that we're looking at, again, for insurance, as I mentioned, is liability risk from exposure to climate change. And then perhaps the bigger question or concern is how exactly do you identify businesses to invest in and determine that they will stay relevant in a greener economy in the next 10 to 15 years. So looking at opportunities really, because right now most of the discussions, the conversation is around risk and not enough about opportunities. So it's not yet very clear for most banks, and for us, we are at initial stages of learning more about this. But it's very critical for us when we um, since we are raising a blue bond, and before that an ASEAN sustainability bond early this year, so we need to put those funding or those investments in the right places and the right businesses, and that's what we need to determine as one of our risks.
Thank you, Mala, for that. And I guess taking on to the topic of, that risk as well, Prerna, we were talking about climate risk monitoring earlier, and, we know that that has a fair bit of uncertainty, including shifting government policies and regulatory requirements as well, as we just spoke about, making quite difficult for teams to conduct assessments. How can companies tackle the uncertainty, and really what is the way forward for climate risk monitoring?
Well, yeah, that's I wish there was a simple academic response to that question. I think one thing's for sure is the uncertainty. So I think the answer lies somewhere in between a very sort of philosophical and a practical view. So the one thing I can sort of highlight here is that there are two major sources of uncertainty that one needs to be aware of when tackling climate change and continuing to monitoring it. One is the uncertainty related to the future. Obviously, this again can be tackled with various climate scenario analysis, and having some sort of flexibility when you're doing that analysis of adjusting assumptions along the way. Assist with climate risk monitoring. Perhaps not choosing one particular climate scenario, using a multiple series of temperature targets and scenarios, and that combination can also, in a sense, help one in getting an understanding about how things may pan out in the future. So that's one thing. And then the second source of uncertainty, and that is related to the fact that there is no way in backtesting the results of one's analysis, any of modeling related to climate analysis for that matter. And so the use and the importance of an analytical tool that incorporates perhaps a heuristic approach to modeling that is transparent, sufficiently granular, and can help one understand, how various drivers of financial impact are panning out. That can be another way that can help tackle that uncertainty and assist with better climate risk monitoring.
Thank you for that, Prerna. I'm going to move on into the I think what I think is quite an interesting topic here in terms of the standards that we have right now. Some worry that companies will fail to disclose the necessary standards, or really view it simply as a checkbox exercise. Some others really worry about the quality and veracity of the data as well. As sustainability data, as we know, it's not audited at the moment. So how do we ensure that the disclosure is robust, and how are regulators thinking about these implications? Michael, this question will go to you, and then I would love to get everyone else's thoughts on this as well if they can respond.
Sure. I think in essence, we need commitment within companies to make sure that the data disclosed is accurate, is relevant, is material to the company's business. And the way that I think we are looking at it is to enable the governance and leadership within individual companies to make those determinations, to set forth the governance structure within the company, to ensure that they can monitor the disclosures. So what we've done, I think, recently is really to require all companies to send their directors for training, one-time training on sustainability, in order to understand their roles and responsibilities in this regard. I think the other thing that we've really looked at in enhancing the reliability of information disclosed is on requiring the company to conduct an internal review of their sustainability reporting process. And this review is to be conducted by the internal audit function within companies. The idea really is that ESG risks, ESG controls should be no different from any other business risks within the companies, like IT risks, operation risks, financial risks. And these should be subject to the same level and same structure of governance. So what we're asking is that the internal audit function within companies look at the sustainability reporting process, identify any material weaknesses in this, recommend enhancements to the audit committee or the board of the directors, and then for the management and directorship to implement these changes. I think on this point, I think something else we really looked at is whether or not external assurance should be required for all sustainability reports. That is probably the requirement in the EU for sustainability reports, requiring companies to subject the sustainability report to a limited assurance. And I think in the US proposals for Scope 1 and Scope 2 emissions to be subject to a limited assurance as well. But I think the way we looked at it, this is going to be a developing area. We need to build up capacity as well as capability of assurance providers, of companies themselves in engaging and conducting these assurances. And in the meantime, we think that there's probably more appropriate that even within the company, the internal audit function performs some role in enhancing the reliability of information.
Thank you, Michael, for that. I think you also kind of answered to or alluded to questions that are coming in the chat box. And thank you, everyone, for sending in your questions. I think on that point, I would love to hear from Marla, maybe Sherry as well. I guess on how companies are tackling this and how assurance providers also play a part in helping the company towards the sustainability target.
So I agree with Michael in terms of the internal audit. We do that for our sustainability report at BTO and for the sustainability function as well. And along with that, we also do compliance testing, and both the compliance group and the internal audit group report their findings to our board audit committee. So in that sense, the way our ESG and sustainability governance is structured, the board audit committee is in charge of oversees the results of the audit and the compliance testing, and the other areas are also distributed to other committees in our board, such as the executive committee, the compliance, the corporate governance committee, and risk management committee. But really, to help companies or to help businesses and banks in particular be better at disclosing so that it's not greenwashing, we really need to have more sector specific reporting guidelines. Because the reality is, we do have a lot of data, but what data exactly do we need? And what does that data mean for us? There are questions around which consultants should we get to help us to learn about best practices, to look at how we are doing, or what our proof points are compared to others, and how do we really measure for our industry? How do we interpret them so that we know that we are actually making progress? So really more questions than answers, but I think starting with a common sector specific standard would really pave the way for better disclosures for companies and for banks.
Yeah, I tend to agree with Marla. I think as companies progress in their commitments, many of them are starting to leverage on voluntary standards, and looking at both the CDP or signing up to the SBTI and looking at the Dow Jones Sustainability Index, where they can benchmark themselves in terms of their disclosures against their peers. And obviously, this sense of peer competitiveness is good to kind of raise the bars for companies, not just in disclosures, but also acting on some of their commitments. And then I would agree, I think that there is a need for more consistency around data, and you are seeing certain sectors rally around providing, a benchmark against like the top performers within a sector, through voluntary standards like the Higg Index for the textile sector. And I think it becomes a very relevant tool to look at, how do you perform against your peers, and having a very consistent way of reporting data and a consistent boundaries in which, you are looking at how you look at your data and report it.
Thank you, Marla, Michael, Sherry, for sharing your thoughts on that. I'm actually going to move on to some questions in the chat box just because it's getting quite active there. And we were talking about, I guess comparing ourselves against peers and other companies as well in the region. So this is one is from Robin. I know, I guess Puma is not really in any of your sector really, but Robin says here that Puma became the first company to put a value on environmental impact in 2011, and few have followed since. How far away are we from seeing companies in Asia that are genuinely triple bottom line firms, which put a real value to environmental and social impact on their balance sheets? Does anyone want to take this question first? No? Sherry, Michael, maybe? No? Michael?
Yeah, I think I alluded to what the SEC has proposed, which is to start incorporating impacts into financial statements. I do see this as a developing area in terms of how ESG is accounted for within the reporting sphere. And I think increasingly it will be reflected in the top line or the bottom line of the company. I mentioned the ISSB, and maybe it's also noteworthy to mention that it is set up under the auspice of the IFRS Foundation. So obviously they're going to look at it with a finance or accounting lens. With I think these standardized reporting tools and matrix out there, I imagine that companies would be reporting against these standards, and then I think incorporating these impacts into their financial statements. I think that also goes back to our earlier point about how really all this information is useful for investors, financial institutions, and hopefully that is I think the outcome that we would achieve.
I just maybe like to answer this in a different way. I think some of the commitments that are coming from some of the front runners is actually paving the way, or I hope it would pave the way for investments into the supply chain to help, say, particularly in the agricultural sector, for smallholders to actually better their practices, invest into certification such that they're becoming more competitive and are able to sell into the marketplace. So what I'm hoping, that front runners like Puma, or even companies like Unilever or Microsoft, it's actually leading to investments in the ground for implementation to happen and accelerate, and particularly in APAC.
Thank you, Sherry, for providing that perspective as well. I just also want to go into quite a practical question, I guess, and also to dig into your experience too. Can you tell us more about some of best practice examples really of where companies have incorporated ESG authentically into their business models, really going beyond the basics? I'm going to pose this to maybe Sherry first to start off with.
Yeah, so I think one of the things that we are really looking at is to invest heavily into R&D and innovations to really understand how we are supporting farmers to become more resilient. And actually, a lot of what we do is really to ensure that farmers can farm better, farm more efficiently, have higher productivity, and as a result of that, lower environmental impact. Obviously, one of the biggest challenge coming out of the IPCC report is that the agricultural and forestry sector accounts for 24% of all of the emissions globally. So we, along with many of our peers, have a huge role to play in the solutions to actually deliver more farm efficiencies, and in that sense be able to reduce environmental impact. And then I guess to maybe answer one of Robin's other question is about what other things do we see in the ag supply chain is obviously human rights, and today with the Russia-Ukraine war is the impact of increase in raw materials, in fuel prices, that is threatening food security, and you're really seeing some of the restrictions that's coming from countries like Indonesia banning the exports of palm oil, or India coming out to say no exports of wheat. So I think it's really about also ensuring that we're helping to be part of that solution to drive food security and working alongside government to look at how we can partner with farmers to ensure that we're addressing this food security challenge and need.
Thank you, Cheryl. That very, very insightful. And going on to Marla as well to answer this question, and also to everyone else, thank you again for putting your questions. And for my speakers, if we don't have time to answer all the questions in the chat boxes, also do feel free to answer to the questions directly in the chat box as well. But for now, Marla, would love to hear from you on best practice examples. You're on mute.
Oh, sorry. Honestly, for us, we are looking at BBS as our best practice reference in terms of how far they've done for disclosure and how their management is approaching common challenges for banks. But specifically for us at BDO, I would say that it really would be embedding ENS criteria and risk categorization in our sustainable finance operations for institutional banking. And this has enabled us to support the country's nationally determined contribution to the Paris Agreement and account for a huge part of the total installed capacity for renewable energy in the Philippines. And aside from that, we have also invested heavily in green buildings, in energy efficiency projects, and looking into more agriculture and biodiversity projects now. And this was all before reporting was made mandatory, or before there was this focus on risk mitigation. So I would say that we are a bit ahead in terms of integrating that in our banking strategies and business goals.
Thank you, Marla. And we'd love to hear from Michael as well on what you've seen.
I think Sherry and Mala raised great examples of how companies in different sectors are responding to this. And I think it really depends on the business of the companies. What is the materiality of, for example, climate risk to your business? For example, an oil and gas company investing heavily in R&D into renewables and trying to see how they can transition out of certain industries. I think that is probably the most difficult pillar within, I think, the TCFD framework on strategy, doing a senior analysis and then considering what action a company can do in order to move out of certain industries. So I think there are going to be examples out there which shows this major shift, but I think I would also give credit to other companies which are looking to fit their action within their existing business, for example, in the green building sector, and looking at making sure that new buildings meet green building standards, or retrofitting an existing portfolio of properties in order to meet these standards. I think these are all going to be action that companies are taking, or have taken, that shows their commitment to ESG.
Thank you, Michael, for sharing your insights as well, to Sherry and Marla. I'm going to go on to a question from Mark in the chat box, and this will be going to Purna. We see a lot of organizations are committed publicly but lack the support of software to manage their ESG performance. How do you see the situation, and how would you encourage the use of software to provide organizations with better data quality, accuracy, and performance management in terms of target achievements?
Yeah, so I think just on that, couple of things that we're specifically making inroads in as S&P is making acquisitions in this space. So, whether that's our acquisition late last year of the Climate Service, which is again a great sort of tool to assess average loss of assets, which may be prone to physical risk. We've made similar acquisitions much earlier on, ahead of the curve in the market, of True Cost, which was more on scope 1 and scope 2 emissions data at that point in time. And in doing so, we've come to create large databases of information in order for us to create relevant benchmarks or estimates when one doesn't have enough data on companies that you're looking to examine. So when these sort of approaches are available, I would say that it does make it easier for one to access data from sources that that have done the data quality checks for you and standardize the information for you. The other, I would say, open source and that I found particularly helpful is the network for greening the financial system, and that is another great area in which you've been able to see various climate risk scenarios as well as scenario variables that are relevant not only on a global level but on a downscale country level, and that can assist with with modeling and looking at how can one really assess the impact of various climate scenarios while conducting credit risk assessments. So I would say, look to access these sources, Mark.
Thank you so much, Purna. And Amarla, I know that you also replied to that question in the chat box, but I'm not sure if you have anything to add there or elaborate on your response.
Well, maybe just to add that a lot of institutions have been making studies around this because it's becoming a huge issue for many companies, for many banks. So there should be more options or at least results with recommendations at some point. But offhand, it's either you do it on in-house, which is what we're trying to do for the SM group, where which BTO is a part of, or to come together with others in pursuit of a common open database.
Thank you, Marla, for explaining that as well. I'm going to go to Sherry for a question from Athena. With the rapidly changing ESG regulatory landscape and war on talent, how is your organization ensuring that you have the right resources and expertise to adapt?
Yeah, thank you, Megan. I just wanted to make one point in the last comments, if I can, is what I hope to see is a harmonization of reporting standards and not a proliferation of them. Because unfortunately in sustainability, there are so many requirements. It is just the reporting becomes sometimes out of control. But to go and answer, and thank you for this question about, the organization. I have to say, kind of in my career, I've been very fortunate to have started very early into both the agricultural sector and in sustainability. And what I can definitely say is that sustainability is no longer seen as the sustainability box that sits either in communications or corporate affairs. And it is now very much embedded within the organization. And, I obviously manage a very big community in Bayer, looking at public affairs and sustainability. And what I actually would like to see is more of a integration of sustainability into the business and the development of talents from within the business to drive sustainability, so that you don't necessarily have a sustainability qualification to do sustainability, but actually everybody within the organization should be thinking about integrating sustainability into their day-to-day, from R&Ds, driving innovations, to the way we engage with growers and our clients, to the way we engage with governments on regulatory issues. To new product innovations around digital and digital tools. So I think that said, it's really about building capability and really about how eventually we run ourselves out of a job, because it's just very much part of the day-to-day of doing business.
Thank you, Sherry. And Marla, I'm not sure if you had anything to comment on that as well.
I'm good. Thanks,
Oh,
Megan.
you're good? Okay, great. Okay, and I think hopefully, in terms of answering that question, I know that we spoke about as well about, kind of incorporating sustainability or ESG authentically into the business as well. And I know Preeti had a question, on how we ensure that it's integrated into the DNA of the company. And we did talk about it earlier as well. So I hope Preeti will answer that question. But I guess on that front, we're talking as well about the alphabet soup really of the reporting standards and frameworks. I want to hear from the panel, what do you think the near future holds for this? Will we see a unification, or will regulatory authorities really continue the current way of tailoring, international best practices to their own unique circumstances? I would love to hear from Michael on this one first.
Sure. I think about a year back, the International Organizations for Securities Commissions, the IOSCO, which I think represents the securities regulators of the world, worked together with the IFRS, the GRI, SASB, CDP, the major sustainability reporting standards and framework setters, to put out a position paper, essentially saying that the way that they look at reporting standards is twofold. Firstly, there are standards that are investor focused, maybe as an example, SASB, which looks at the information which would impact on enterprise value of the company. For example, any ESG risk that impacts on the company. And this lens, this investor-focused lens, forms a basic building block for companies to start looking at sustainability, in addition to traditional financial analysis, traditional financial information. But on top of this building block, companies can also choose to adopt a multi-stakeholder focused lens, which I think is best represented by the GRI. And if this information is indeed what investors demand and is what is material to the company, then this information should also be disclosed. And with this, I think, building blocks approach in mind, the IFRS went on to set up the ISSB, which has now put out a consultation for a hopefully global sustainability reporting standard that all companies, all markets can adopt as the investor-focused lens, which also then gives a better information to investors on the enterprise value of the company. On top of this, companies can also add on a multi-stakeholder focused lens by also additionally adopting the GRI standards. And I think we've seen essentially a convergence of, I think, the different frameworks into these two building blocks. The investor-focused ones, for example, by SASB, the integrated reporting framework, and then the multi-stakeholder focused one. I think that's exemplified by GRI. And I think that is likely, going to be the future of our reporting standards. So hopefully we don't see more divergence from there on.
Thank you, Michael, for that. Sherry, did you also want to comment on that?
I think Michael covered most of the points.
Okay. Yeah, no, I thought so as well. That was really comprehensive. But I also want to, this actually came to me privately as well, in terms of, regulations by stock exchanges. We know now that it mostly covers only listed companies, but also the bulk of state-owned enterprises and SMBs that Power Asia really are not obliged to disclose right now. Do you think there will be regulation change in the near future to govern them too, and really should it? I think this will go to Michael first as well. I'm sorry to keep posing these questions to you.
Yeah. Well, firstly, they don't come under I think the listed space, but maybe speaking more broadly, in I think 1 or 2 years ago, the UK published a roadmap for how the entire UK economy can transition towards a state where every part of it is reporting on its climate risk and action. And they've decided to, of course, start with financial institutions, with listed companies, but they've also laid out a roadmap for all other corporates within the UK to start reporting against the TCFD as well. I think increasingly you would see different markets also adopting the same standard, not least because the ISSB, which I've mentioned many times, is meant for corporates to report against, not just for listed companies, right? And I think with just the focus on from different I think governments around the world on climate, I think it's very likely that we'll see it proliferate not just within the listed space, but also to the unlisted space.
Thank you for that, Michael. I hope that helps as well, the SME representatives in this chat too. I'm going to go on to one question, quite a broad question really, from Maria in the chat box. Is Asia already prepared for the green banking transition? I will go on to Marla first, and then we'll take it from there.
I would say that we are on our way there, and that definitely is the goal. But we are at different stages of moving towards that. Um, but I think it's very clear expectation for the financial industry, particularly for banks, that our role is really to fund the energy transition primarily, and that would entail a lot of funds annually for that to be successful. So we see that as a responsibility that is closely tied up. At least in our case, it's closely tied up with the country's commitments to the Paris Agreement, and we recognize that in our journey for BDO, for example, looking at that context, we know that there will always be trade offs, or we recognize that we will always have to do a balancing act between supporting national economic recovery that really requires more affordable energy sources and balancing that with the broader goal of climate sustainability. So it's not always um, clear cut. We will always have to come to difficult decisions when it comes to practicing green banking and transitioning to that. But the commitment is there, and the opportunities is something that we are also looking at, and the risk is something that banks are trying to manage with the support of their respective central banks.
Thank you so much, Marla. I would like to go to Sherry now to provide her opinions on this.
I guess this is more kind of personal observation, and obviously there has been a lot of pressure by campaigning organizations and NGOs to say stop financing fossil fuel, and instead. But I think that there is a role for the financial sector to actually support in the transition towards a less fossil fuel dependent society. So that's one area. And then I guess the second area too is that, we are starting to see a lot of examples of investment funds, as well as private sector companies actually saying, we would like to co-invest with you upfront in supporting farming. So we have an initiative that we started in India around rice carbon farming as a pilot on 3,000 hectares to support farmers on the transition from a conventional way of growing rice, which is very water intensive, also a lot of high carbon emissions, to actually a direct seeded rice that uses less water, less labor, and carbon reduction savings are quite significant. And actually there has been a lot of interest to support the upfront investments to get farmers to make this transition and actually put a price on carbon such that it is an incentive for farmers to change. And actually, so I guess in part of this greening opportunities, it's really to say, how do we shift investments to where the impact can be most significant and work alongside private sector in that supply chain to really support that transition?
Yeah, and maybe
If
I
I
can
may
add.
just
Please go ahead.
add to that, sorry, Michael. So the on the other hand, there is the need to support the energy transition, which banks recognize, and on the other hand, there is also the need to support existing clients to go through that transition. Banks can't just leave their clients struggling because we have to provide for both um, the transition towards a better or more less emission uh, um, less emissions for clients that are into fossil fuel businesses and less investments for them, but there is also the social component in terms of employees of those clients who will be losing their jobs and communities who will be losing sources of income and livelihood from those projects. So that's part of the balancing act as well, which we would hope would be part of any energy transition plan for financial institutions.
Yeah, maybe I'll add to that, but maybe from another perspective, just by looking at the demand for green investments in ASEAN. I think there's been some research done to show that the annual demand through 2030 is up to 200 billion US dollars. Uh, but the supply is only 40 billion, so um, demand well dwarfs the supply of green investments within the ASEAN region. And the primary drivers would really be demands for infrastructure developments within ASEAN, for renewable energy, for food and agri and forestry projects. And the private sector is expected to play a leading role in this. So from the demand perspective, I think it is a huge opportunity for ASEAN banks.
Thank you, Michael. And Marla as well for providing those very interesting insights into what your thoughts were on that. And Pern, I just wanted to go to you as well to share your thoughts on this.
Yeah, I thought I'll add to a different perspective as well here. So um, I was actually thinking about, some of the important announcements that were made at COP26 in November last year. And, at that point in time, a lot of new announcements and commitments were made by countries, which, then give us cue as to how we would see upcoming, policy changes from the financial systems of these countries, and where APAC figured and where APAC didn't figure would give us again some cue on which financial institutions would really lead the pack in making or helping transition to a greener economy. So if you sort of think about some of the takeaways from COP26, at that point in time, before the session, only half of the global economy in terms of GDP was aligned to net zero targets. Now, post COP26, it's more than 80% of the world's GDP, and many countries in Asia have also committed to achieving net zero by 2070. Then there was the methane pledge, which took place again over 100 countries committed to reducing methane emissions by 30% by 2030. So again, one can take cue from which financial institutions, part of these sort of 100 countries would be assisting countries reach that goal of their methane pledge. And then third and finally, for the first time ever, there was a specific day at COP26, which was dedicated to finance. And here we saw the Glasgow Finance Alliance for Net Zero, which included around, I believe, over 400 financial institutions across countries, many APAC financial institutions as well, committing to helping accelerate the transition to a net zero economy. So again, here is where we can take some more leading indicators of how APAC financial institutions will continue to play a role, evolving at that in helping understand how economies can move to a more sort of greener technology. Obviously, the allocation of capital, will then help, make that sort of, wiser and better decision for the purposes of net zero commitments.
Thank you, Prerna, for sharing that. With the interest of time, I'm going to take one more question from the chat box before I end off with the final question for all our speakers. And this one, it's again from Michael. Is Singapore likely to be the first country in APAC to come down hard on greenwashing and ESG disclosure? And also, if you want to continue, what sort of regulations could work best to clamp down on greenwashing in the sector?
Thanks for that. I'm not sure whether we would be the first, but I would say that greenwashing is definitely a concern for regulators in Singapore. And indeed, it's a concern for, I guess, securities regulators around the world. The IOSCO has put out a concept paper highlighting the potential greenwashing areas from the securities markets perspective. And this is not just in relation to companies' disclosures and what they do, but also in terms of the products that are being offered to investors, whether or not in marketing these products, there is risk of selling and overselling of the green aspects, whether or not labeling of these products as green is indeed accurate and accurately reflects the investment objectives of these products. I think what you'll probably see is more guidance out in the market for investors when making these investment decisions, and what they should be looking out for in terms of disclosures to make sure that it aligns with their investment objectives. I think that you would probably see developing globally as well as in Singapore.
Thank you for that, Michael. I'm not sure, Sherry, you also wanted to comment on that.
Yeah, I guess all I would say is ultimately as regulators and consumers become more aware and more savvy, I think they can pick up on what could be considered as greenwashing or green marketing. But ultimately, I guess the most important is to measure companies on their ability to translate commitments into action and really report on tangible actions. And we just need to do more as a community in Singapore and amongst sustainability peers to really encourage more action on the ground, because that's where you're going to start to see more change and impact.
Thank you, Sherry, for ending us on that note. But just one more question to all our speakers before we end off. 30 seconds for you to do this, just because we're running late on time. What is one major force at the top of your mind that will shape the climate risk and reporting landscape going forward? I will start with Marla.
I would probably say it's a common standard. That would be an earth shaker or a game changer for everyone, and something that will help us better align all our metrics and targets and performance.
Thank you, Marla. And let's go on to Prerna.
Yeah, I would say capital markets or the financing community. I think they can be a major force and a positive one at that if they can have the ability to influence and help shape transition plans of companies. I think that's quite significant, and ultimately reduce the vulnerability of companies towards climate risk.
Thank you, Prerna. And Sherry?
I would say more collaboration and partnerships between regulators, governments, and the private sector to really accelerate on the ground change.
Thank you, Sherry. And last but not least, Michael.
Yeah, I started by, I guess, highlighting the important role that TCFD played in bringing us here. I think the next important thing to me, like I think what the panelists have mentioned, really is the ISSB standards that will be hopefully adopted within global securities markets in partnership between regulators and private sector players.
Thank you, Michael. And thank you to our audience as well for putting in all your very, very thoughtful questions into the chat box. To Michael, Prerna, Sherry, Marla, for providing us with such a thoughtful and much needed discussion on adapting to the changing regulatory landscape in Asia, and also providing ways for companies to go about incorporating ESG authentically into their business. So for today's session, we talk about various topics, including the importance of climate risk monitoring despite uncertainty, how companies' top management must be committed to understanding the reporting frameworks that put to them, the need for guidance and capacity building from regulators or otherwise, and also embedding sustainability in the organization instead of this just being a tick box exercise. So I think it's quite safe to say that we're working today from today's session with a deeper understanding on the ESG regulatory landscape in Asia and how businesses can best prepare themselves against these requirements. And for that, thank you, Michael, Prerna, Sherry, and Marla, and to the audience as well, as we have come to the end of our dialogue. I would like to thank again our speakers as well as the audience for making the time to be with us this afternoon, and I hope you found this conversation as enlightening as I did. Please do spend a few minutes to answer the poll question that will be shown, and also give us some feedback on this event from the link that you will see in the chat box as well. Don't forget to use our hashtags EB Conversations and Ego Business if you are sharing your thoughts on this session via your social networks. Thank you everyone again, and have a great evening ahead.